Picture a 100-foot yacht with custom leather seating anchored right in the heart of Monte Carlo. The air smells like expensive cigars, and you're surrounded by tech moguls and seasoned venture capitalists. These elites aren't there for a party. They are desperate to hand over their millions to the guest of honor, who happens to be a 19-year-old college dropout. He looks like someone who should be cramming for a chemistry final. Instead, he is supposedly the founder of the most exclusive hedge fund on the planet, managing a massive global portfolio. When you see a teenager living on a super yacht, your first instinct is usually to assume he must be a savant. The glitz of the environment distracts from the numbers and bypasses standard financial scrutiny. Getting into a room with high net worth investors at 19 requires playing a specific part. In finance, everyone is hunting for the disruptor who sees patterns where others see noise. This creates a powerful fear of missing out. No investor wants to be the person who passed on the next Steve Jobs. They apply that exact same logic to the stock market. They are terrified of missing out on the early days of a Warren Buffett. The teenager actively leaned into this. He projected the image of someone entirely too busy making money to sit through a university lecture, creating an intense, manufactured urgency among potential clients. The clients wanted the miracle team to be real. Their desire to get in on the ground floor overrode their instinct to verify his credentials, leading them to hand over real cash without asking hard questions. The operation relied on a high-end office right in the middle of a major financial district. Visitors were brought into a room glowing with green numbers, flashing tickers and complex graphs. It looked exactly like a legitimate trading floor, but none of those terminals connected to the actual stock market. The software was effectively a sandbox, a financial video game generating massive, entirely fictional returns. While he was clicking buttons in a simulation, the actual client deposits were funding an incredibly extravagant lifestyle. The designer suits, the private travel, and the yacht in Monaco served as props to convince a second wave of investors to buy in. He built a perfect feedback loop. The illusion of extreme wealth brought in new capital, which bought more status symbols, replacing any actual trading strategy. Making up investment returns month after month creates a scaling problem. Every fabricated number has to tie perfectly into the next. This chart represents the polished investment PDFs he distributed, featuring individual monthly returns above and a grand total at the bottom. But the math failed. The individual returns in the top rows did not match the final total calculated at the end. An accountant working for one of the investors finally looked past the glamorous branding and ran the rows and columns through a calculator. A charismatic story and a luxury office will bypass a person's emotional skepticism, but they cannot hide basic arithmetic mistakes. Once investigators pulled on that single thread, they found a complete vacuum. There were no assets and no trades, only a series of bank accounts used to shuffle the initial deposits around. In high finance,
exclusivity frequently acts
as a deliberate mask to keep people from demanding transparency. Elevating a youthful dropout to genius status is a cultural
bias.
It frames a profound lack of experience as a badge of honor rather than the massive risk factor it actually is. These elite investors were not outsmarted by a complex high-frequency algorithm. They were defeated by their own reverence for manufactured status and their eagerness to believe in a miracle. The first warning sign in any financial arrangement is an extreme level of exclusivity that actively blocks third-party audits or open communication. This graph illustrates the
second warning sign.
You see the natural, erratic path of a normal market alongside a suspiciously smooth, straight upward trend. Real investments fluctuate, always demand independent verification of the data, no matter how official the document looks. The ultimate defense against a highly sophisticated fraud is an objective accountant, because while people will lie to sell a story, the numbers have to tell the truth.